We're at a very important crossroads where the market needs to decide what it's going to do. Set all the narratives aside. The market just needs to decide what it wants to do. And then whichever way it breaks out, trade that trend.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the fraternal portfolio manager, Lance Roberts. Lance, how you doing?
The older I get, the more paternal I feel.
Thanks. Although I said fraternal,
Oh,
for two
gotcha.
reasons. One, because I've just spent the week with my brothers. I had a rare week away from the computer. It's been wonderful. We
Nice.
get to end today's video actually a little bit early because I've got to take one of them to the airport. But also, Lance, because I think of you as a brother.
I appreciate that. Same,
Yeah,
same goes for me.
thanks. But I don't like my brothers, so
It's okay. I don't like
you
mine.
can understand why. Yeah.
I haven't spoken to my real brother in 25 years, so there you go.
Yeah. Well, there's probably a story there we'll get into at some point.
No, that story doesn't need to be told.
All right. Um, all right. Well, look, so folks, we're gonna keep today condensed and pretty on track. Um, Looking at the markets, Lance, I've been starting to hear in my mind the Talking Heads song "Road to Nowhere,"
Yep.
where the market's trading kind of as we speak, is where it was trading before Halloween
Yeah.
of last year, and we're just about in March now here in 2026. So it really has gone, pretty much nowhere in the past number of months. Um, so a couple questions for you, Lance. Last week, we talked about how the market could be sort of healing here, or positioning it, consolidating and positioning itself for a run higher. Curious to hear if you still think that way. And what we have seen certainly so far this year is capital rotation out of the hyperscalers and the software companies, into more value plays, right? It's been a growth to value transfer. When we talked last week, you were beginning to say, hey, like especially with some of these software companies, like the baby's getting tossed out with the bathwater, there may be a good opportunity to start building positions in these beaten down companies and wait for capital to then re-rotate back into growth from value. Do you still have those sort of same perspectives, or has anything changed in the past week?
No, nothing's changed. Timing is always going to be the hard part, right? So, trying to get these rotations, exactly perfect are going to be difficult. So if you're going to try to play, areas of the market that are under a lot of pressure, just be careful that you're going to have to maybe sit with them for a while, and it's going to kind of be dead money for a bit until the market actually starts to realize that a lot of these narratives that are out there that are kind of driving this current environment are not valid. And when you start looking and when the market starts looking back for where there's a margin of safety, they're going to start looking for companies that have really good valuations and a good moat and a good margin of safety. And a lot of those companies reside in that tech space right now that have been particularly beaten up.
Okay, so maybe we can, we'll do some of the charts in a bit. Maybe you can show us on the chart kind of where capital is still flowing right now and where it isn't. Um, but let me ask you this, and maybe we should just go to the TA and kind of get that over with today.
Okay.
Um, Technically, I'm doing this from memory here, but we had a break down below a couple of daily moving averages, and we were waiting to see if the markets could recover and bounce above them, or if they were going to start acting as resistance. I don't think we've broken back above them, correct?
No. Well, actually, we did. So this was a really interesting week overall. And I wrote about this in this weekend's newsletter that's coming up. It's called, is the market topping or not? Because there's certainly some indications that this market could be in a topping process. And so we want to certainly be aware of that. But if you look back at this week, we opened the week lower on Monday over these kind of AI concerns issues. And then the market rallied back over the next 3 days, and got up, we came right off the 100-day moving average, tested that support, came right off that support level that we've been doing now really ever since last April, broke above the 50 and the 20-day moving average. So that was actually looking pretty good. And then
Oh,
on Thursday and Friday, we reversed all that. We're back down to the 100-day moving average. So we've not gone anywhere this week. So, from a trading standpoint, it's been a bit frustrating if you're long an S&P index fund or whatever. But there's just been this continued kind of consolidation. And every time we rally back up to these resistance levels, we fail and come back down and test support. Now, the good news is that buyers keep stepping in right at the 100-day moving average. We get down there, buyers step in and start buying the market. So that's okay. We haven't broken. Now, if we break the 100-day moving average, which is this black line, then potentially we've got, kind of reversal down to maybe those November lows potentially, which would be around 65.50-ish, somewhere around there on the S&P. So, a 3 to 4% correction, that's completely normal for the market. Shouldn't be anything to be overly concerned about. But the question is that if we do get that kind of a sell-off, is it going to continue to be in the technology space, which has been under the most pressure, or do we see those stocks start to hold up better from a valuation standpoint, and we start to see these really overvalued stocks in staples, energy, industrials, materials, utilities? Do we see those start to sell off and money rotate back to safety in the other direction? Remember, this whole rotation we saw was that overvalued mega cap space into the value space that you and I talked about last October. We said, hey, watch out for this. This is why we're adding some value stocks to our portfolios. We're looking for this rotation. That rotation has now occurred, and now technology is actually cheaper on a forward valuation basis than staples, industrials, and energy, all three of those sectors. So you're overpaying now for the valuations in those kind of value sectors. They're no longer value anymore. And the growth sector has now become much more of a value sector than it was, 6 months ago.
Okay. I just got to ask you, because we're looking at this chart here. I'm guessing you sort of drew
Parabola.
that parabola there at the top. Yeah. Because you look at that and you think, oh, well, that clearly looks like the market's topping. And I'm sure you were doing that for whatever article you were writing, just asking that question.
Exactly.
Yeah, okay. So folks watching this or looking at this chart shouldn't read too much into that. It's really just sort of think of that as a question mark. What would you need to see, Lance, because it sounds like this could even break down to the November lows, and you wouldn't necessarily say it's a rollover. You might just say it's a shallow correction. What would you need to see to think that it was something bigger to the downside?
We need to take out those November lows. And by the way, those November lows are right about where the 200-day moving average is as well. So, there's certainly some concerning signals that are starting to show up. And let me back up here just a little bit. So the 20 days is about to cross below the 50 days. So that's not a great signal, right? So that's a bit on the bearish side. Certainly warrants some caution. And because of that, because of this kind of action right here, we reduced our exposure in our equity model a little bit this week. Nothing major, just a little bit. But last time we had that occur was back in kind of January 2025. The 20 crossed below the 50, then immediately reversed and went up into March. And then, of course, March was where we had the whole tariff, situation resolve itself. But so these kind of crossovers are important to pay attention to. Now, on the good side, we've got a momentum buy signal in place right now, and relative strength, the market isn't really that overbought. So from a technical basis, we've already this consolidation has kind of worked off a lot of that big overbought condition that we had back in, September, October last year from that huge run up from those April lows. We've worked off a lot of that situation. So, downside risk is becoming less. But again, 3 to 5% corrections are completely normal. And that's kind of what we laid out in that kind of South Park article, at the beginning of this year is like, expect a year of lower returns and more volatility. And so far, that's exactly what we're getting.
Yeah.
We've got a lot of volatility, a lot of rotation within sectors. Like I said, volatility's picked up here a bit. It's been a little bit more challenging. If you're an ETF indexer, it's been a little bit more challenging of a market this year. If you're more of a stock picker, it's been a little bit easier because you just kind of pick stocks in certain areas that are doing well. So from being a stock picker basis this year, it's actually been pretty decent. But if you're just kind of an index investor, it's been a little bit more challenging.
Okay. And we've talked about this when markets become more volatile, the passive strategy that everybody's been using for the past 15 plus years, it doesn't generally doesn't work nearly as well, and it's where an active management approach really tends to do a lot better, and that you can actually do well even if the market goes sideways, right? If you're catching the cycles within the process well.
Right, exactly.
Yeah.
You know,
Okay. No,
you
go
know,
ahead.
and right now the market's just holding up support. This kind of dotted black line right here is just kind of these bottoms that we've been running, and the market just has been. This is more of a consult. The article this weekend is just laying out the kind of the is this a topping process? Here's kind of what the technicals say. Could this just be a bullish process building up for the next like higher? I kind of go through that as well. So it's kind of a bull bear point counterpoint type argument. Because again, we could easily break out. If we get to new highs, this consolidation, we'll look back and go, yeah, it was a great consolidation. Should have been
Right.
buying the crap out of the market because this market's now ready to run. So we're at a very important kind of crossroads where the market needs to decide what it's going to do. Set all the narratives aside. The market just needs to decide what it wants to do, and then whichever way it breaks out, trade that trend.
Okay. And right now, do you have a gut feel or an informed feel, one way or the other? Are you leaning more towards a breakout versus a breakdown, or vice versa?
No, I don't. And that's the challenging part is if I had a gut feel. So we've been running so ever since the April low. Let me bring my chart back up here real quick, and let me just kind of talk you through this. So back here in the April low, on April the 7th, right here, we added a bunch of exposure to our portfolio, and we were underweight exposure in equities. We were about 50%, 52% equities during this decline. So we'd reduced our exposure during that whole tariff rumble. And then then at this bottom in April 7th, we had, if you go back and look, the sentiment gauges that we run and the allocation gauges that we run were at the lowest level since the financial crisis. The sentiment was so negative, positioning was so negative. It was just like the buying opportunity, and it was just so we actually overweighted our equities. Our target weight in our 60/40 allocation model, as an example, is 60% equities. We got down to about 52% going into the correction, and then coming out of that correction, we went to 65%. And we ran 65% for most of last year. So we were overweight equities, underweight fixed income and cash. We took that back this week. We're now back to just target weight equities because of this consolidation process. Now, it doesn't mean that I'm concerned about a breakdown now, but I'm starting to position myself that if this market begins to break down, I can more easily get underweight equities sooner than having to come back down through the cycle. So I'm kind of positioning potentially for this to be more of a risk off trade, but I'm not expecting a giant crash, but a 3 to 5% correction back to some of these previous lows would not be surprising at all. That could certainly happen. There's certainly some concerns out there from Iran to tariff policy to AI, et cetera. There's all these kind of things that are out there that are weighing on the markets. So if we get this correction, I don't expect it to be deep because the economic data is still very good. The earnings data is extremely strong. So whatever correction we get is going to be shallow and will be a buying opportunity, but I don't want to ride that down. I want to have some cash available to buy with if we do get a dip. If the market breaks out, then I'll go back to overweight equity and we'll just trade whatever next move as it comes up.
Okay, that makes total sense. So just to be super clear for folks, when you say
Mhm.
target weight equity, that's 60%, right? Because you run a
Right. Well,
60/40 portfolio.
right. So in the 60/40 model, it's 60%, and the 80/20, it's 80, and the 20/80, it's 20, right? So whatever the target weights of the models are, that's where we've gotten back to right now.
Okay. All right. All right. Well, folks, we'll be tracking this week to week from here with Lance, and when he can't be here with his partner Mike Leibowitz. So you'll get a strong sense in real time of where things
Mhm.
are headed. Especially, if we do get a breakout one way or the other, we'll then adjust accordingly.
Sure.
All right. So you mentioned a couple of uh, concerns that the market has right now. The day that we're talking, Friday,
Mhm.
there are kind of two dominant narratives in the headlines. One is that PPI came in
Mhm.
hotter than expected.
Yep.
U.S. producer prices came in at 0.5% month over month versus expectations of 0.3, and higher than the revised number of 0.4 month over month in December. They're up almost 3% for the year. So, a little bit higher than folks expected. This is being driven by services
Right.
mostly, which have been sort of disinflating of late. So this is a bit of a reversal in services. So all of a sudden the market's thinking, oh, okay, maybe inflation is going to be a little bit more of an issue than we thought. The other thing that's going on, which we'll talk more about in a second, is sort of renewed fears of the disruption that AI is going to bring to the corporate landscape. And the company that's got everybody's attention right now is Block, which is run by well, I'm blanking on his name, Lance, but he's the guy who founded Twitter, Jack Dorsey.
Jack Dorsey,
Um,
yeah.
but today, basically, Block announced that it's laying off half of its staff, or approximately half of its staff, because they're saying we just don't need them with AI.
Right.
That the AI models we're running are starting to do the work of salaried people. So
Right.
let's start first with the PPI. I know this is one data point, right now, so don't make too much of it. And I guess my question for you, Lance, is does it in any way alter your thinking that I think you and I have shared up to now that 2026 is more likely to be a year of disinflation than inflation?
So there was nothing really shocking in PPI today. It's not surprising that it ticked up a little bit. If you take a look at all the Fed manufacturing indexes, Chicago PMI, Philly Fed, regional Richmond Fed, Dallas Fed, they've all been upticking lately. So economic growth is coming back, and
Yeah.
we're starting to see a pickup in economic activity. Again, so setting aside GDP, as an example, GDP was 1.4% in the fourth quarter. And as we talked about, that was all due to the government shutdown. So that's going to come back pretty sharply in January and in the next quarter. So when we see first quarter, we're probably going to see a 3% GDP growth in the first quarter, something around there. But because you look underneath the surface, all these manufacturing indexes are coming back rather strongly. This is that reflation trade that we've been talking about here for a while, is that the hyperscalers, they're spending all the money on this Capex to build out these data centers. Well, that's going to translate into economic activity. And so we're starting to see that actually show up now in the data. So it's not surprising that PPI picked up here a little bit. Again, as you noted, it's mostly in services right now. Energy prices have come up a little bit, so that's feeding into it, but energy prices aren't running off to the moon right now by any stretch of the imagination. So, we're starting to see a little bit of a pickup there, but PPI is still running at, like I said, 2.9%-ish. And we run a composite between the CPI and the PPI. So if you take CPI and subtract out PPI, it kind of gives you an understanding of who's absorbing all the cost. And for the last year, the reason we haven't seen any inflation is because all the producers were having to absorb all the cost increases from tariffs, et cetera, and they weren't able to pass that on to consumers. Well, that's been recovering. And right now, that differential between CPI and PPI is about negative 0.8. So it's almost neutral, where it's almost an even balance. They're the consumers and producers are basically just trading off on prices right now. So it's very close to that. So we're starting to see this kind of repair within the system of things kind of going back to more normal levels. And this, we had big divergences coming out of the COVID pandemic, obviously, because we shut down the economy. And that's all starting to normalize. So now we're starting to get kind of more realistic numbers for where we are. But if you kind of look forward, this is, again, like you said, this is one number. And if you take a look at PCE and some of these other data points that really kind of lag inflation data a bit, inflation expectations are declining. The 10-year Treasury yield this morning is trading below 4% on that number. So if the bond market's looking at that number and going, this probably isn't going to be the case for very long. We're probably going to see some more disinflationary pressures later on this year. And so the bond market's already kind of starting to read off on that PPI report. So just from a standpoint of, if you're trying to make a case for inflation to come surging back, you might see a little bit of an uptick because of increased economic activity, but that should be expected.
All right, and Lance, to your point there, the people who care the most about inflation are bondholders, because inflation eats into your real returns.
Right.
And if they were concerned about rising inflation in the future, you would be increasing bond yields to be compensated for that. And as you said, we're kind of seeing the opposite. So right now, at least the bond market's not that worried about this post here. Um,
Well, that's also kind of one of the headlines I saw this morning, is that, PPI comes in hot, stagflation now the major fear. But stagflation, when you look at the definition of it, it's stagnant economic growth, high unemployment, and high inflation. CPI at even 3% is not high. So inflation at 3% is not high. I mean, 7, 9%, that was high inflation last year. But economic growth is not stagnant. I mean, again, we're running pretty strong rates of economic growth last year, with the exception of quarter four because of the shutdown. And if we start to run 3.5% economic growth this year because of all this capex spending, and unemployment's obviously not high right now, right? You take a look at the unemployment data; it's still very low. Um, it's hard to make that stagflation argument at the moment. This is more of an inflation caused by economic activity.
Well, and I think our point here is, you know, uh, it's a blip
Hmm.
so far. It will continue in the future. I don't know. We'll look at it here. But uh, there's a lot of reasons to consider or to believe that the headline CPI inflation measures are going to continue to disinflate for reasons that you just mentioned, and the
Yeah.
bond market seems to be in concurrence with that. Um, I did want to ask you about the PMI, the Chicago PMI numbers, which just came in today. And you've already kind of taken the conversation there already, but let me just share this chart. So you'll see here from this chart, Lance, that for the past 2 months, PMI has really rebounded. So you can see, basically since the middle of the pandemic, we've been in contraction mode here in the manufacturing space by these readings, right? Anything less than 50 is considered contraction, and we've kind of vaulted back up into expansion over the past two readings here. Will this continue? Who knows? But this goes back to the question that I've been asking you for, past several of these weekend chats is, the administration has been saying, hey, look, we've been doing an awful lot, since we got elected to sow the seeds for material economic expansion going forward, and it's starting to kick in here in 2026, and that's why Bessent has been saying, I think 5% GDP growth's in the cards, and Lutnick's been saying, well, I think it could be a lot more than that. Trump
Mhm.
obviously is putting a ridiculously much larger number on that. And so, I've been asking, well, what do you think? I mean, could this be a year where the GDP growth surprises to the upside? I think both you and I are definitely open to that. And you look at that
Sure.
PMI chart, and that's what you would expect to see if what the administration is telling us to expect is actually starting in process here. Now, we'll have to keep tracking it going forward, but I give that as sort of early validation that I don't want to say that the golden age is arriving, but the age of uh, boosted GDP, those are the early signs you would expect if we were indeed entering into that.
No, absolutely. And this is something that I actually had talked about on, I think Friday, maybe Wednesday, on our YouTube channel. But I was showing this chart. So this is CapEx expenditures by hyperscalers. You've all seen this chart before. This is not new. But here's 23, 24, 25, all in the dark blue. And then the light blue is expectations to come. So if you think about this for a moment, what we're seeing occur in the economy, you should have, this was very expected. And, because again, once I start spending money on CapEx, I'm spending that money to go do stuff, right? So we're talking about 500 data centers being built in Texas. North Carolina's building a crap load of them. Idaho's building a bunch of data centers. Well, that's putting people to work. That's buying, materials, cement, building roads, building out electrical plants, et cetera. So all that's feeding into the economy. So we should be seeing that translate into stronger economic growth. So here's two points on this. One, if we do get 4 or 5% economic growth, like Scott Bessent's suggesting, I don't know if we get there or not. There's a lot of other factors that kind of feed into things. We'll talk about the consumer here in a second. CapEx is 15% of GDP, right? So you can do a lot of CapEx, and its impact on GDP is not going to be all that significant because it's only 15%. But the point is, you should see an impact, and we're seeing that again. Chicago PMI, the New York Fed, the Richmond, the Dallas, all those Fed indexes are all turning up. We run a composite between ISM, the manufacturing and services indexes, and the manufacturing side of ISM has been negative for like 2 years. It turned positive this past reading. It's back into expansion territory. Services never got down there. So, we're seeing that translation of that spending into the economy. Now, you're going to get inflation a little bit of inflation, if you have 5% GDP growth, you're going to have 3.5, 3.7% inflation. It's just you can't have that kind of economic growth activity without a pickup in inflation because you're causing demand within the economy. But
Sorry to interrupt, but the
right,
reflation trade basically says, yeah, but it doesn't really matter that much, right? Because if we're growing faster than inflation, and
that's right.
importantly, wages are growing faster than inflation, then consumers are better off net net.
Absolutely. Now that you get the A plus for today's analysis.
Oh, good. Boy,
Now,
you
now
never give me good grades. That's
I know
excellent.
exactly. But now keep that now set that aside for just a second, and then let's talk about the other side of this, the consumer. Consumers, and this is really kind of today's article that I wrote as well.
Yeah.
It's on the website.
Can I make one point before you go there?
Sure.
Because I just
Yes.
want to comment on this chart here. So some people might be looking at this chart and saying, okay, Q1 of 2026 has the highest bar, but then the bars start falling off from there. So
That's right.
maybe the future isn't going to be as big as the past. I just want to point out, this is percent increase. Am I
Right.
correct here?
That is, yes, you're
These are
correct.
the growth rate, right? So the diminishing growth rate as you go into the future is just due to the law of large numbers, right?
That's correct.
And
And
so
but it is notable if I am if my spend rate, right, is slowing down, right, even on a percentage basis, that is going to feed into the economy. So looking at this chart, we should expect that this boom of economic activity we have is not going to be sustainable long term. Because again, let's just step back, forget this chart for a second. Let's just talk logic for a moment. Once I build all the data centers that I need, then what?
yeah,
Right?
totally different point. A good point. But let me just make my point, and then you can
Sure,
finish
sure,
your, which is, so you just pull the chart back up if you can.
sure. Yeah, absolutely.
But so I think like at the end of this year or at the beginning of 2027, it drops down from 86% in Q1 to, yeah, 47%
Mhm.
by Q4. Just remember that 40% is a 40% growth from the total number the quarter before, right? Which is going to
That's
be a
right.
lot bigger than it is right now. So it's still
Oh
an
no, this is not
awful.
quarter before. This is year over year. So not quarter before, year before.
Oh,
So
okay.
if I did 1 million last year, then I'm doing 1,000,005 this year.
Okay. All right. So it's a year over year growth.
Yeah.
Okay. You're right. I see year over year. All right. So then maybe it may diminish. My question here though was for a good while here, for the next couple of quarters,
Mhm.
at least, if not next couple of years, we're still going to be having positive year over year growth. And, look, 47% year over year growth from a
It
large
ain't
number
nothing.
is a lot, right? So all I'm saying
Exactly.
is there's still going to be an awful lot being spent,
Yes.
and that number is going to continue to grow throughout at least this 2 year projection. So don't look at this and thinking like, oh, the spigot's drying up and there's going to be no Capex spending. It's like, no, the growth rate may be slowing, but it's still going to be a ton of spending. So it's going
Yes.
to employ people, all that stuff.
But yeah, but correct. And then but at some point we will have built all we're going to build. Well, we will have built most of it, right? So there's this initial rush to go build all this stuff, but eventually that's going to slow down.
Yeah. And don't worry,
And
we're going to talk about this part when we get to AI and jobs displacement and all
sure,
that
sure,
stuff.
sure. And so once we get all this stuff kind of built initially, yes, we're going to continue to build new data centers, but that spin rate and the speed and the velocity is all going to slow down, and that's going to feed back into economic growth. So a lot of these trades that we're chasing today, as an example, when you're paying historically high valuations for energy stocks, historically high valuations for industrial stocks, you're really depending upon the spend rate for construction to be running almost inevitably into the future. And that's
Yeah.
just not going to be the case. And it's always interesting. Everybody's so concerned about technology. It's like, oh, tech's in a bubble, it's all going to blow up. But you can also make the case that a lot of these other sectors of the markets are starting to get into bubble territory as well from a historical basis. I mean, you're talking about industrials and staples trading at valuations we haven't seen since the dot-com crisis. So, it applies to all areas of the markets. And so the point is just simply to look ahead and say, where does this look like in the future? Which brings us to the consumer, which is 70% of GDP. Savings rates are dropping like a rock right now, 3.5% on consumer savings rates. The credit card kind of spending rate is still going up, but that kind of rate of change is starting to slow down, maybe suggesting consumers are starting to become a little bit more kind of tapped out. And given the weight of the consumer in the economy, to where I know you're going to go to, Adam, if we start having a big reduction in layoffs, et cetera, that's going to certainly impact the ability of the consumer to support the economy. So again, going back to percentages, yes, I'm spending a crap ton of money in Capex. That's 15% of GDP. The consumer is 70%. Who wins that battle?
Right. Right. Okay, good. This is opening the door for where I want to go with this. Just I want to note one thing you said, which is, I'm not saying this is the case, but if everybody was concerned we had a bubble in AI, and now you're saying, hey, we may have a bubble in value. Yeah, the hyperscalers and the growth traders, some of the froth has come off here, but I'm just saying there's the potential that there is a bubble in both. Right? And
Right.
if there are, to the warriors out there, that raises the idea that, hey, if I was worried about the AI bubble, maybe there's an even bigger bubble for me to worry about here. Again, folks,
Right.
I'm not saying that's the case, but it's just
No,
one
no, no.
potential outcome
Just
here.
pay attention to valuations. It's just valuations are important everywhere, not just in tech.
Right, right. And just to echo Lance Roberts, the fact that valuations are stretched is important signal, but it's not a good important. It's not a good timing signal,
Right.
right? This stuff could be elevated for a lot longer than you imagine.
Absolutely.
Let me ask one thing you mentioned earlier too. So you were talking about CPI and PPI and the difference
Mhm.
between the two, and that largely the producers have been eating the impact of the tariffs.
Yeah,
Um, I believe that to be true. I don't have the most recent data on this, but the last data I looked at was that corporate profit margins were still in record territory.
they are.
So, they've had the ability to eat the impact of the tariffs because they've been doing so well relatively. Are we seeing any change in that right now? Like, is there any
Well,
reason to think that the corporations would start trying to push any continued inflation onto the consumer yet, or can they still eat it?
it's kind of a tough question to answer today at this moment. I'll tell you why in just a second. Can you see this chart right here?
Yep. It's a little
Um, so,
small, but yeah.
okay, let me see if I can make it a little bit bigger here. Hold on for me. This is the blue and the red. This is my spreadsheet, so I apologize for the kind of the non-formal view
No,
of
it's
it.
cool. We get to see the sausage being made.
Yeah, if you really want it, here it is. So the black line is earnings. This is reported GAAP earnings year-over-year percentage rate of change, and the blue and the red is the differential. This is the spread between PPI and CPI. So when you'll notice that when earnings are booming the most, that is when it's the favor is tilted towards the consumer. When it's negative, that's when it's not the favor is not tilted towards producers, right? It's a disadvantage for producers. If it's blue, it's a disadvantage to consumers. Consumers are having to eat it. So that makes sense, right? Because if I'm able to pass, if when the consumer is having to eat the inflation, that obviously boosts my earnings and vice versa. So we've been seeing this recovery. You'll see this red line, this red valley here has been recovering ever since 2022. When we got through that 2022 kind of sell-off in the markets, earnings troughed, and then we began having to recover. And slowly but surely, we've started to transfer the price pressure from the producer back to the consumer. The reason I can't answer your profit margin yet is because profit margins are only posted quarterly.
Yep.
So as of right now, this is net profit margins versus the 10-year break-even inflation rates. And and as you can see, just looking at profit margins, they've been stagnant here for a while. But I think once we get this first quarter in, I think we're going to see that uptick to about 18%-ish, somewhere 18, 19%, be somewhere in that range. So I think we're going to see an uptick in profit margins because inflation rates have been, kind of the inflationary pressures have been pretty low. So that's been helping to boost profit margins for companies.
All right. Well, let me just ask this, and it's kind of a naive question, but like, if that's true, if what you think is going to happen is true, and profit margins go back up, how can they justify or otherwise get away with potentially passing additional tariff increases on the consumer when they're making so much profit on a historically comparative basis?
Well, if the world worked in a manner where we all did what was best for everybody else, then this would be a very different world that we lived in.
Hmm.
But the bottom line is simply this, is that if I may, so my bottle of water that I bought from Costco, right? Let's say I sell it for $1 normally, and my input costs come up. But this is a really hot selling item at Costco. I don't know if it is or not. I just
Yeah.
buy this there. Um, but let's say this is a really high demand product at Costco. And Costco says, well, my costs have gone up, so I'm gonna charge $1.25 for this now, and people keep buying it, then they're gonna sell it at $1.25. And if they sell out at $1.25, Costco's gonna go, well, I'll sell it for $1.50. And they're gonna find the point to where consumers rebel and say, I'm not gonna buy that product, I'm gonna go buy a different product that may be cheaper. But that's just business. That's just the way capitalism works. So, there's not a, what drives prices is the supply demand imbalance. And this is the case for everything. Stock prices, grocery prices, egg prices. If you have two, we had with the avian flu, we had chicken prices, egg prices go through the roof because we didn't have enough eggs. And people were willing to pay $8 a dozen for eggs. Now there's a huge supply of eggs, and and consumers are going, yeah, I'm not paying that anymore. So,
Yeah.
the price of eggs have come down. But that's just the way capitalism and
Well,
markets
that's
function. Yeah.
supply and demand in a
Yeah.
free capitalist market. And I'm looking at the time and realizing I got a lot more wood to chop, so I don't want to
Good.
get too distracted on this. But I'm going to say something that might sound a little like, oh my God, that's socialistic. And
Probably.
so you and I have ranted that we don't really have free unfettered capitalism, right? We have corporatism, crony capitalism, whatever you want to call it, right? And we have a lot of industries that are kind of more like run like cartels, right? Where they have a lot of pricing control. They've paid off regulators to get huge regulatory moats and stuff like that, right? So um, the so one could make the argument, hey, they have artificially high profit margins now, and they are sort of scalping the consumer. And of course, the long-term blowback could be not just consumers stop buying their stuff, but they actually complain enough to our elected officials that, they start going after companies for windfall profits or,
Which you definitely do not want to have happen. That's
uncompetitive
that's
practices.
that's a terrible outcome to do that. The better solution to solve the problem is stop buying iPhones, as an example. Just if y'all would just stop buying iPhones and start going to buy an Android or go buy a flip phone for a year or so, watch how cheap an iPhone will get.
Right, or
The
practice
consumer, the
frugality
consumer,
on lots of things. Yeah, I'm there
yeah, the
with you, and we
consumer
could we
has
could rant about this a lot,
yeah,
but
yeah. I'm just saying the consumer has total control over prices. It's just you've just got to be willing to sacrifice buying whatever fashionable trend item there is on the markets. I mean, there's no difference between an Apple and an Android phone, but you just pay a lot more for an Apple just because you want to buy the brand. There's no different. Look, I think Starbucks coffee sucks, but people buy Starbucks coffee because it's a culture, right? It's a thing. I can buy better coffee at the grocery store, but that's just me. But if we all stopped shopping at Starbucks, the price of Starbucks would come down dramatically.
yeah. So let me earmark this because what I want to dig into here is something happened in recent years where corporate profits went up to a new level,
Yep.
a new high plateau. Something is keeping them there. And
Hmm.
the question I want to dig into is sort of why and, you know, is this healthy? I personally gut feel don't think it is, but I'll be open-minded here. And what can be done about this, right?
Right.
Whether does consumers just have to band together and say, we're going to adopt a culture of tightening our belts a little bit and force these guys to bring things down? Or is there stuff going on? And look,
Sure.
I'm the last guy to say that like the government should be setting prices. And I'm not making that argument at all. But, is there something here? And I wonder if this is sort of where, the administration when it's saying, hey, we got to make sure Main Street gets a turn and whatnot, where there may be some things at times where they say, hey, look, if there isn't problems with tariffs, whatever, you guys are going to have to eat, you guys, the producers, are going to have to eat more of it while your profits margins are above a certain amount. It's interesting.
Yeah.
We don't have time to get into it,
Yeah.
but I
Yeah.
just want to put a pin in it because I think there's something there to really explore.
Sure. Yeah, we can do that. No problem.
Okay. Um, so let me just talk real quickly about Block to get your thoughts on this. So as I mentioned, their stock soared. It was up at least 16% as of this morning on the news that they're basically firing half of their workers here. Um, and Jack Dorsey is saying, hey, like this AI stuff's the real deal. I think you're going to see a lot of companies following our lead. In fact, we think a lot of them are late to realizing exactly how transformative these AI technologies are going to be for corporations. It's about enabling higher ROI in growth and free cash flow. they're saying, and economies at Goldman Sachs have estimated that AI was responsible for job losses amounting to a 5 to 10,000 hit to average monthly job growth to the industries that are most exposed to it in 2025. So they're already looking retroactively and saying, hey, a certain amount of job losses that happened last year were because of this trend, and it's probably going to continue going forward. So my question for you, Lance, is, we've been debating how much of a job killer AI is going to be. I think we both think it's probably going to be pretty substantial material, but we're now starting to really see companies like Block
Mhm.
fully embrace it. I mean, to the point where you're firing half your workforce in one fell swoop. It's kind of nuts
Yep,
to think about it. So, how big of a deal
it's
do
a big
you
deal.
see this? Is this a real signal that we're going to start seeing some real job shedding as we go into 2026?
Yeah, yes, and again, this was a chart that Warren Pies put out last week, showing the differential between AI exposed companies and AI non-exposed companies, and those companies are still adding jobs. Companies that are exposed to AI, those are the ones that are suffering the biggest job losses. So, and that's not surprising. We talked about this before, is that if you have a job that is very systematic. Every day you do the kind of the same job every day, right? You enter data into a computer that,
Right,
or
especially if
or
it's
some
software
sort.
based. Yeah.
Yeah, yeah. You're going to lose your job. There's just no way around it. That job is going to get replaced by AI, and that's just a function of time. Companies, right now though, you AI can't build a data center, right? So we're hiring a lot of construction people. We're hiring a lot of electricians. There's gonna be like 500,000 electricians that need to be hired over the next 3 years,
Right.
that type of stuff. So we're going to see a shift in the job market. And yes, there's going to be AI related employment destruction. And, for people at the bottom of the ladder, they're going to love this because the jobs are going to get cut are going to be a lot of the white collar jobs. It's like, all you rich people finally getting the axe. Well, we're going to see a lot of those jobs because, if you're in sales and marketing and that type of stuff, AI can do that job pretty quick. Look, my job is very exposed to AI. This is why we're developing Simplivisor AI now because it's that future of portfolio management is coming. It's just a function of time, so we need to get ahead of the curve. Um, you know, Honestly, Adam, your job's at risk. How hard would it be to create an artificial AI
Oh,
developed Adam Taggart and have him do interviews, right?
yeah. I don't know me specifically, but probably pretty easy. But there's a lot of competitors in this space already that
Yeah.
are AI generated.
Yeah, exactly. And that's what I'm saying is like, you can look at most jobs and go, yeah, AI can definitely impact that job. Now here's the point. I just did this interview with Forbes yesterday. They read my article on nihilism and they wanted to do a piece on it. And so we had a long discussion on that yesterday. And the reality is that we saw that you'll remember this, right? So back in the 90s, you and I saw a lot of jobs go away because of the internet and .com, right? There used to be receptionists. We don't have receptionists anymore. The fax machine changed a lot of things that were going on. FedEx changed a lot
Sure.
of things. So these
Travel
innovations,
agents, dead.
yes, right. So these innovations, they come along and they do impact the job market, but we also have to look back and go, yeah, but new jobs came out of that. Things that you and I aren't even thinking about today. There's going to be some job that comes out of AI that AI will breed. Again, I have no idea what it could be, but there will be new jobs that will be created, new opportunities. People are going to start, as Elon Musk was talking about. AI is going to allow people to start businesses like crazy, right? So if you've been working for somebody else forever, AI is going to allow you to start your own business very easily in a lot of different areas. So, we're going to see a lot of job creation as well as seeing a lot of kind of traditional jobs are going to go away, but new jobs are going to come along. So we'll see what happens. Now the question's going to be though, here's the question. If the let's just say we lose as many jobs as we make. Let's just say that. But the new jobs pay half as much as the old jobs. That's a problem economically,
Right.
right?
Or
Because
we,
we're 70% consumption driven.
right. And then the other thing too is even with your generous assumption, which my gut doesn't share, but that's
It's
for a
just an
different day.
example. Yeah.
Yeah. But even in your example, we gain as many as we lose. Huge question is okay, if we lose all the jobs today,
Mhm.
how long will it take to get those new jobs? right? Are people out
That's
of
right.
work for a month or are they out of work for 4 years, right?
That's
Like that's
right.
a huge question.
It is a huge question. And then, this is where this is where I think we're making a mistake politically. If I was President Trump, I would be starting to talk about spending money to build out training centers, trade schools, these type of things. Hey, we're going to start an initiative. We need 500,000 electricians. We're going to need plumbers. We're going to need construction workers to build all these data centers to support AI. We're going to fund an initiative to start trade schools. We want to get you out of the inner city into a trade school and into a good paying job. I would be focusing on that and doing those type of things, help people start retraining for an AI driven economy. Look, you're not stopping AI. AI is coming. It's here and it's coming. But we're not doing anything to help people start transition. Everybody's kind of just sitting here waiting to be axed by AI instead of getting ahead of the curve and start getting certifications in AI. One of the differences that's going to be made is, look, software companies aren't going away, but they're going to be adopting AI to a large degree. So on your resume, you better have some type of AI certification somewhere on your resume, because whatever job you're going to go into, they're going to be using AI in some shape, form, or fashion. So get ahead of the curve and start. There's online courses that you can take to get an AI certification. Just do something to get ahead of the curve before your job comes to risk.
Yeah, I saw a chart. I don't have it handy, folks, sorry, but I saw a chart recently and it was the American population divided into these tiny little squares.
Mhm.
And uh, there were three colors. There were people that just aren't using AI at all. There were people who are using a publicly available free AI service. And then there were the people who are actually paying to use the AI service, subscribing to get the better AI and presumably
Yep.
do some higher functioning work with it. And it was just a couple of squares that were in that category, not much more that were using it as a free service. And then, I don't know, 98+% of the rest of the country that's just not engaging with it
Yep.
yet. And basically, the point of that whole chart is like, if the tsunami is coming, the vast majority are just totally unprepared for it,
They
right?
are.
So
Absolutely.
again, we don't have a ton of time to dig into this. The key thing I wanted to make is, you and I have ranted about the potential disruption of jobs from AI. I'm a little skeptical about how many jobs it's going to create going forward, especially when combined with robotics. I also am a bit skeptical about what you said earlier is there's going to be a big manufacturing boom in this country, probably for the next 5 to 10 years. But what after that,
Right.
right? And of course, by
Because
that time, the
it's
robots will have learned how to weld themselves too, right?
well, not only that though, but let's say that it takes 5,000 people to build a data center. These data centers are huge. They're like 10
Yep.
football fields, right? So let's say it takes 5,000 people all together to build a data center. But after it's built, you need 200 people to run it,
Right.
right? That's the downstream problem with construction and these type of companies that we're all chasing right now and overpaying for valuations on companies like Caterpillar and Deere and these other companies. I mean, they're great companies, nothing wrong with them, but the valuations are just extreme, and we're assuming that this pickup in revenue is infinite, and it's not.
Right. And again, to that displacement of like, okay, when we don't need most of you anymore. Like I agree with you. I think that AI is going to bring tremendous opportunity for those who, are proactive and entrepreneurial and want to create their own company. And it might be a one-person company that's just run by all the agents that you create, right?
Right?
Um, but being honest, I think that is a relatively small minority of the population that's going to go that way. And it's what happens with everybody else. And the reason why I'm bringing all this up here is just, I think what happened today with Block's announcement, it's a sign that, this not only is it game on, but this pace may be faster than almost everybody, even those that have been following this space, maybe have been predicting. So, if you're
Well,
trying to keep your head in the sand, you might not have a lot more time before you really have to pull your head out and start thinking.
yeah. Now, one thing too, just also remember that we've had a boomer 3, 4 years in the market, right? Things have been very good for
Yep.
corporations over the last 4 years. So we had a lot of over hiring too. So part of and I'm not saying that what Block did today was simply just getting rid of over hiring, but companies tend to, when boom times are really good, we tend to hire kind of over hire or hire a bunch of people that we start kind of duplicating jobs and things like that. So when things start to slow down or you have something like AI come along, the layoffs may seem a lot bigger than they are because they're getting rid of a lot of that
Well, they're
excess
not big, they're
overhead.
not bigger than they are. They're not maybe as bad as we think because
Yeah,
you're kind of
yeah,
getting at the
they're
deadwood, the less
exaggerating. Yeah,
productive stuff, right?
and
But
I'm
it
not.
doesn't mean it's sorry to
Yeah,
interrupt,
yeah,
but like there is, I think there is a lot of
yeah.
underperforming labor out there, or excess labor, and so even if it's just job shedding of the non-essential jobs, like that could be pretty material. I
Yes,
mean,
again.
just to your point about consumer spending, these are people that are losing their income and not necessarily going to get a replacement anytime fast.
Absolutely right. And so I just want to make sure that we all just approach things with a little bit of rationalization and not just to like, oh my God, everybody's just laying off, everybody in the world's coming to an end. Look, I agree with you. I think the job losses are going to be large and the responses to those job losses are going to be key. So again, I think the government needs to get involved with, setting up trade schools, those type of things, at least providing some support for those. Companies need to provide training. I think a horrible idea. Elon Musk was talking about the fact we're gonna have to have UBI. I think if you want to destroy the economy, put everybody on UBI because you just
Our
remove
economy and our
purpose.
culture, right?
Well, that's what I mean, because you just remove purpose at that point. If you don't have purpose, then society gets really bad really quick. So, I think that's a horrible way to go. So I hope we make better decisions. We'll see.
We'll see. So the
Yeah.
reason I'm bringing all this up, and we'll move on to closing up here,
Yep.
but is I think the way I'm looking at it, I have a hard time seeing the near term, like the next couple of years, as we increasingly go in this pathway, as the prospects for the employer rising and the prospects for the working class net diminishing.
Yep.
So I think there's going to be new jobs, the data centers and all that stuff, right? Like there's going to be cohorts that are going to find new jobs, and that's all great. But I think that we're probably going to be losing more than we're creating, and the ability to then jump to something else really interesting that pays you as much as you were making or more, I think is going to be a challenge for people. So I just see this unfortunate period where if you're frustrated with the fact that companies already have record profits and all that type of stuff, and the consumer has not been getting their fair shake, I think it's probably going to continue for the foreseeable
Yeah.
future.
And look, this is thoughtful money. And so that's what we're here to talk about, right? So if you're worried about that happening to you,
Take those actions that
don't
you're
wait. Don't wait for it to happen to you. Start saving today. Look at your budget, cut back on your spending, put more into savings, put more into investments, invest prudently. Don't take a lot of risk so that capital, when something happens, is still there for you. But start building that safety net. So if something happens to you, you've got 6 months of an emergency fund or a year's worth of an emergency fund sitting in cash in the bank for you to live on, to get between jobs, to retrain yourself. And don't wait to get retrained later. Start today. Start learning AI. I just ditched ChatGPT and I moved over to Claude. Claude is freaking amazing as to what I am so impressed with Claude and what it does and how it operates. It's made my life so much easier just in the week I've been using it.
It's really interesting. I haven't used it recently. I kind of use Grok just because I'm on X a
Oh,
lot.
10 times better than Grok.
Really? Okay.
No,
All
yeah,
right,
way
well, I'll go
better.
check it out. So I totally agree, and folks, both on the financial side of things, so that if bad news happens to you, you've got the best cushioning for it. But also to the future of Lance's point about like start skilling up, start trying and not just as a defensive measure, but to Lance's point, you might find ways to say, wow, like I could really use AI to either make myself even more essential at work, or maybe detach from my employer and go off on my own now that I can do all this stuff that I wouldn't have been able to do before. So there's a lot of opportunity
Or,
there.
or here, learn to use AI to displace the other guy's job that you work with and secure your own.
Yeah.
So
Yeah, they say your job's going to get replaced more likely not by AI, but someone who knows how to use it. Identify the people at your company you don't like and figure
be
out how
that
to
guy.
use AI to
It's
get
like,
rid of
hey,
them.
boss, look what I can do. You don't need Jim anymore.
Exactly. All right. Just want to get your temperature on one quick thing, and then we'll get to your trades and start wrapping up. Um, we are continuing to see concerns mount about the private credit space.
Yes.
And I think this happened by last week. I think we talked about Blue Owl and it freezing redemptions on one of its business development funds. And
Sure.
that kind of, that definitely raised some eyebrows. And again, not in and of itself a sign of crisis, perhaps not even for Blue Owl per se, but certainly makes the investing world a little bit more nervous about how bad some of these private credit loans may have been because we don't have any visibility into this industry.
That's right.
Today, we just got word that a firm called Market Financial Solutions over in Europe and England, I think,
Okay. Yeah.
basically declared bankruptcy. And shares of a number of big banks there, like Barclays, are getting hit because they've got some exposure to that. But basically, this is sort of like another tricolor, another first brand. It's just making people think, you know what, maybe Jamie Dimon was right. You see one cockroach, that probably means there are more.
Sure.
And how I know we don't have a ton of visibility and data here, Lance, but
Mhm.
from your perspective, uh, how worried, if at all, are you of a market moving event happening in the future if indeed we start seeing more and more casualties of private credit here?
Well, so first I'll understand I don't have exposure to private credit. We don't do that as a firm because of specifically a lack of liquidity, transparency, and opportunity, right? So
Right. But you
we
have
don't.
secondary exposure where if there's like it's not going to be a Lehman moment per se of scale, but if the market freaks out because all of a sudden it's
Well,
about, yeah.
that's what I was getting to. So we don't have any private credit exposure directly. So what we pay attention to is how is it affecting spreads in the liquid markets that we are in. So predominantly we're treasury focused. We do have corporates in our bond portfolios. So we're watching those credit spreads very closely, and we've seen those uptick here just a little bit lately. Not anything of major stress right now, so not overly concerned. MFS is certainly a deal, right? It's 2 billion. It's about $2 billion, so it's not nothing. But in the size of the private credit market, it's a very small fish.
Yeah.
So again, whenever we hear about this stuff, we immediately, and look, my nature is too. I immediately go back to the financial crisis and go, "Oh, is this the next subprime crisis?" And we all remember what happened with Lehman Brothers and all that.
Hmm.
I don't think we're there just yet, but I do think you have to pay attention to this. You and I have been talking about this for a long time, is that, the stuff with this buy now, pay later nonsense, this private credit lending, whenever you have so much money chasing so few assets, you're going to get a lot of bad deals.
It
And
always ends poorly.
yeah, and it always ends badly. And so you get these bad deals because these managers have to place these funds. So this is why it's so important as an investor that you understand what you're investing in. Just because somebody comes and pitches you a private credit fund or private equity fund, ask yourself, why am I so lucky to be getting this? If why are they coming? Why is your advisor coming to you with this when Sequoia and these other big hedge funds and VCs will buy this stuff right off the cuff, and they're in this stuff already. So you're at the bottom of the list. So why are you so lucky to get this really outstanding opportunity? And that's where you have to be really careful, because that's how you wind up in these funds that have like an MFS or a tricolor in them, because they're trying to boost returns and they're chasing poor quality deals to get there to capture money. And again, these people are going to walk away fine. They made their money. It's the investors that take the hit.
Yeah. Well, okay, let me ask you this because I think I'm
Sure.
going to ask you this in the future going forward on this.
Uh-huh.
In terms of your worry level of private credit and its a potential to metastasize to just impact the general markets and make your life difficult as a guy who's
Mhm.
managing publicly traded investments,
Yep.
where is it right now? A scale of 1 to 10, 10 being hair on fire.
3.
3. Okay, great. And
Again, it ain't nothing. If you would ask me 4 months ago, I'd say 1, right?
okay, well, and that's why I wanted to get this on record because I think I'm going to ask you this again and we'll see if it goes up or down from
Yeah.
here. Yeah.
Yeah. Like I said,
Okay.
it ain't nothing. We're definitely paying attention to it, but there's nothing here to be. If you're in highly liquid markets, treasuries, triple B corporate bonds are better. You don't have to worry right now.
Okay. All right. So trades. I think you mentioned you lightened up your equity
You
exposure a
did.
little bit. Any other
So
specific trades?
yeah. So we're doing a couple of shifts. So this week we just kind of reduced some exposure very slightly. We didn't sell outright anything to any great degree. We trimmed back on JP Morgan. We trimmed back on BlackRock just a little bit. We trimmed back on Berkshire Hathaway just a little bit, just to bring our overall exposure down to 60% in the portfolio. So again, we're back to target weight. So in our 60/40 model, as an example, we want to be at 60% weight. We were overweight equities for most of last year. So we're just bringing that back to target weights right now. That gives us the next opportunity if this market does start to deteriorate some, that we're going to see, we can easily reduce that exposure. Now, coming up on Monday, we're going to be starting to dig in a little bit, and we're going to be trimming off. So back in October, we added a couple of value companies, Altria, Verizon. Those have had huge runs. So we're going to be selling Altria and Visa and taking those out of the portfolio because we have some concerns on the consumer side. So we're a little bit worried about Visa. So taking Visa out of the portfolio. We've held it for a long time, but we're going to take it out for now. And we're going to add some money. We're going to use that money. We're going to keep our equity weighting the same, but we're going to add to Microsoft and start, buying a starter position, and like ServiceNow and Salesforce, and start
Okay.
kind of digging into some of these really beaten up software stocks because
Okay. Which is
valuations
what
are
we talked
just
about last
compellingly,
week.
yeah, valuations are just so compellingly cheap here.
Okay. And cash flows are still really good and all that
Yeah,
stuff.
yeah.
So,
And again, we're buying starter positions. I hope these stocks can even go lower, and then I can add to them.
yeah, got it. And
So,
so just to be super clear, you are now putting into practice what you flagged for us last week that you would probably do.
yeah,
Yeah.
exactly.
Okay. Awesome.
And we may be right, we may be wrong. We'll see. But that's why we take small positions.
Yeah.
And if we're wrong, it doesn't hurt us. And this is why you don't go buy big positions and stuff right up front. Just wade your way into it. Make sure that your trade's going to be right, and then you can always build on it if it goes up.
Okay. Yeah, that's brilliant. You may be right, you may be wrong. I think you can say that about every single investing decision you make.
Every trade is a binary bet. You're either right or wrong.
I mean, I guess you can be really right or really wrong, but yeah.
Correct.
Okay. Well, all right. Let's start wrapping it up here, Lance. We don't have time to do a full rant. I just want to give a quick nod.
Sure.
And I was certainly obviously teasing at the beginning when I said I hate my brothers or don't like my brothers. So had a great week with them here. It's really been fun. Got to go skiing for the first time in, God, 15 plus years or so. And it's great doing it out here in the West, especially when you grew up skiing in New England, which we did, which is basically learning to ski on ice.
Right.
Out here, it's just
It's actual snow.
the locals kept talking about it had rained the day before, and the locals kept talking about like, oh my God, the conditions are so terrible. And we're like, are you kidding me? Like this is this is like 10 times better than what we've ever had. So, anyways, super fun, and I just want to say that it'd been a long time since I'd taken some time away from the computer, and it was a really good reminder of kind of the why. I'm doing everything that I'm doing in terms of, work focus and all that stuff. And I just want to, emphasize that so that hopefully folks who are watching here will make some time in their life to do something similar and really remind themselves of, okay, if I'm working really hard to invest, or if I'm working really hard to grow my income or whatever, don't forget to take some time along the way to keep your eye on the prize and say, okay, look, why am I doing all this? And also like, let me enjoy a little bit of it along the way, because tomorrow's not guaranteed, right? We don't know if, that bus might have our number on it tomorrow, right? And we want to make sure that if our life flashes before our eyes, we said, okay, I got enough of the living I meant to do out of it all, right? And look, for me, you hear me talk on this channel about, money, it's important, but it's a means, it's not the end. The end, what really defines a rich life is quality relationships, meaning, and good health. And I just spent 3 days basically having a ton of fun, with family and friends. And a lot of it was really physically active, right? And so it was all three things, right? It was finding meaning in my quality relationships, doing things that I could do because I've been investing in my health. Can't recommend it enough for folks. The only thing I'll say at the end here too is my brothers and I, we do this annually. And it's a great time for all the reasons I just mentioned. But one of the things that we have started a tradition of doing is we spend some time kind of talking about, okay, for each one of us, what's a big goal of yours for the year ahead? And, we kind of get each other to kind of articulate it and put it out there. And then over the coming year, we check in and we try to keep each other accountable for, hitting those goals. And, if we're having trouble or is there setbacks or whatever, we can, talk it through with each other. And it's really become something I think has been really sort of like a force accelerator in our lives. So, Again, you don't necessarily have to adopt that with your own family or your own, inner circle, but we found it to be really useful. So anyways, Lance, I'm gonna wrap up here in just a minute because, like I said, I took one brother to the airport before we recorded. I got to take the other one now. But you're actually happy that we're ending a little bit early too, because you, I think, are going out to spend some quality time with one of your children.
Absolutely. Yeah. We're gonna as soon as we hang up here, I'm on the road heading up to Austin to spend the weekend with actually both my daughters. One's at Baylor and one's in Austin. So we're gonna split the time up there and spend some days with each of them. So yeah, looking forward to it.
All right, great. Well, so folks, if you watch this channel to become a smarter investor, please take what we're talking about here as your nudge from the universe to invest in the things that truly matter to you. All right. Well, look, in wrapping up here, folks, if you think one of the ways to invest your time in the ways that will truly pay the best dividends for you is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to get some help from a professional financial advisor based on any of the things that Lance and I have talked about here, or if the future unfolds the way that Lance and I have been batting back and forth here, I highly recommend that you get that from a financial advisor who at least takes into account all the macro issues that Lance and I have been talking about here. If you don't have one in your life who's already doing that, or would like to get a second opinion from one who does meet those criteria, then consider talking to one of the firms that Thoughtful Money endorses. These are the firms you see with me on this channel week after week. Maybe you'd like to talk to Lance and his team there at RIA. To do that, just fill out the short form at thoughtfulmoney.com and the firms will be in touch with you right away. Lastly, it just hit me, picking my head up after this week, that we only have 3 weeks left before Thoughtful Money's spring conference. So if you haven't bought your ticket yet, run, do not walk, to buy it at thoughtfulmoney.com/conference because we're still offering the lowest early bird pricing, but that's only going to last for the next week, and then the price goes up. So I want to make sure everybody gets that lowest price. And if you are a premium subscriber to our Substack, look in your email inbox for the code I've sent you. You can use that to get an additional $50 off of that lowest early bird price. It's a phenomenal faculty. Real quick, doing this just off the top of my head again, Lacey Hunt keynoting it like usual with his graduate level series of charts. We'll have first timers Ed Dowd, Michael Oliver, and everybody's really interested to get his forecasts for the precious metals. We're going to have famous journalist Matt Taibbi piping in. We're going to have Judy Shelton. We're going to have Danielle DiMartino Booth. We're going to have Luke Roman. We're going to have Brent Johnson. We're going to have Stephanie Pomboy. We're going to have Grant Williams. We're going to have Rick Rule. We're going to have Melody Wright. We're going to have David Hay. We're going to have Michael Howell. We're going to have Darius Dale. We're going to have Andy Scheckman. There's probably one or two that I'm forgetting, but it is just an unbelievable lineup, and that's all coming at you on Saturday, March 21st. That's when the conference is. And if you can't watch live, don't worry, because everybody who buys a ticket will be sent the replay videos within just a couple hours of the event ending. So it's going to be great. But don't forget, if you haven't bought your ticket yet, go now to thoughtfulmoney.com/conference. All right, Lance, as usual, my friend, I'll give you the last word here.
That's it. Have a great time with your brother, and I'll see you next week.
All right. Thanks so much, buddy. Have a great time with your daughters. Everybody else, thanks so much for watching.
Both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold. But that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, we're not right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay, if you go up ninefold this time, it means you're going to $8,500 gold, because our low is 1,050. Right. So a ninefold move from 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stopping at 8,000 is highly unlikely. But even if you went to 8,000, do a tripling of silver relative gold, silver would be at $240.
In past bull markets, silver traded at 3 to 6% of gold's price versus just over 1% today, highlighting major upside if it reverts to historical norms. While gold reaching $8,500 is only a bullish scenario, at a 3% ratio, silver could be around $240. With rising industrial demand, persistent supply deficits, and mounting global debt pressures, silver is viewed as deeply undervalued, reinforced by the elevated gold-to-silver ratio above 90 to 1 compared to its long-term 40 to 70 average. Michael Oliver, veteran market analyst and the founder of Momentum Structural Analysis, highlights that silver is experiencing its largest demand surge in decades, especially in solar, electronics, AI, and defense sectors. Meanwhile, supply is shrinking due to declining mine output and inadequate recycling. MarketWatch describes this as a potential supercycle, with severe supply deficits encouraging a powerful, bullish run. Noting this, Michael Oliver predicts that silver is entering an acceleration phase and could reach $60 to $70 by year-end, surpassing its old highs near $50 from 1980 and 2011. Adjusted for money supply growth and inflation, silver would need to be around $200 today to equal those past highs in real terms. They believe this surge will break well beyond those outdated levels. Silver has broken through long-term resistance at $34.90, surging to $38 to $39, its highest in 13 years, signaling an incredible breakout, with technical targets of $41 to $42 and potential for a larger structural rally. While silver has jumped approximately 54% from $24 this year, mining stocks remain undervalued, attracting institutional and ETF inflows. With industrial demand from solar, electronics, AI, and defense rising against tightening supply and reported deficits, the outlook remains strongly bullish. In order to receive fast notifications whenever we release a new video, please like this video, subscribe to our channel, and turn on the notification bell.
Yeah, they've already done that, frankly. Silver had a high back in October of last year at 35. It dropped. Came back up in March of this year, hit 35 again, dropped. In fact, it had a cleansing drop down to 27.50. And then came back up, and in June, it got up above 34 again. Again, not taking out the 35 plus highs. Okay, they were like 35.50 each. But at 34.90 area, we had a major momentum breakout of a structure that said, okay, silver's coming out of this congestion. By congestion, I mean, if you go back to May of last year, silver was 32.70 at a high. You could draw a line sideways through May of this year, where it was either side of that level, up and down, but really just net sideways. When it got back to 34.90 in late June, we said, that's it, it's coming out of here. Whoosh, it went up to 39. Now, as typical, the price chart guys like to sell round numbers or just in front of them. So let's risk 40, okay? Okay, and now we're trading either side of 39 right now on the September contract. We think the process has already begun that you were asking about. We think the acceleration phase in silver and the miners. Now, for instance, GDX has gone from a sleepy upside pattern to suddenly it's now up to near its 2011 highs. We expect GDX not to even stop until it clears its 2011 highs, meaning get up in the upper 60s. And same with the miners in general. Silver, we think in this move, in this acceleration phase for it and it relative to gold, is likely by the end of the year to see $60 to $70. Meaning those old antique highs at 50 in 1980 and 2011, which are really sort of jokes. Because one, you were up there very briefly, like days, and back down. And when you do a real valuation, the degradation of the money unit since 1980 the increase in the M2, or since 2011 even. Heck, gold would probably have to, silver would have to be $200 now to just match in real value terms those price highs we saw then. So it's catching up. And I think this surge will blow past those, what we call idiot highs. And at that point, what's going to happen? The public's going to say, oh my gosh, I missed this. I got to be in it. And so I think that's when you're going to see an onrush, fairly fresh, of money moving out of the doubting stock market into, hey, I missed this. I got to be in it. The gold, silver miners, and silver. And that's when you get this gush effect. The wet bar soap effect, where everybody's grabbing it, it goes up. This is not unusual in markets anyway, but especially in these situations, I think I think we're in process right now, in other words.
So when we consider that type of move, Michael, do you see this as more of a different type of new high? As you said, this was kind of a silly joke of a high, up to $50 and instantly back down. Do you see this as a possibility of being a more sustained type of new price level for these metals?
Yeah, and both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold. Mm-hmm. Well, that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, we're not right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay, if you go up ninefold this time, it means you're going to $8,500 gold, because our low is $1,050. Right. So a ninefold move from 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stopping at 8,000 is highly unlikely. But even if you went to 8,000, do a tripling of silver relatively gold, silver would be at $240. Is that about right? So it's the point being, when we go up there this time, also the events in the world and in the street events, the academic notions about what works, what doesn't.
Michael also compares silver with gold in a way that he points out that silver has a history of outperforming gold during strong rallies, like in 2020, when silver nearly doubled while gold rose only about 25 to 30%. Recently, the silver-to-gold ratio fell below 1%, meaning silver was priced at just 1% of gold's value, a rare level that historically signals a strong buying opportunity. Over the past few months, silver has started to outperform again, while gold has mostly moved sideways, showing strength that suggests it's entering a new phase of outperformance. Looking at long-term trends, silver often reaches around 2% of gold's price, so doubling in relative value, while gold itself looks ready to resume its upward move soon. The best opportunities right now appear to be in silver and mining stocks, with gold likely to follow later.
That's the growth. Also, state and local government was a huge component the last time around. And usually government hiring has been a huge thing for the last 6 months. And when you look at things like transportation or factory, flat to dead, if not declining. But the overall number looks great, okay? So it's all illusory stuff. And he finally admitted to it. That's great. So anyway.
So, Michael, we've talked a lot about gold and its reaction here. Do you think we should be thinking any differently about silver's reaction, despite the setup for gold with the, interest rates and the equity markets that we've already touched on?
I think silver is participating with gold. It vastly outpaced gold in that 2020 rally. Silver almost doubled in price, whereas gold went up about $500, which is like 25%, 30% rally. Silver doubled. So into mid 2020, silver had outperformed gold on a percentage basis. But from 2020 through, well, the recent low, the silver spread went from like 1.5% of the price of gold down to 1% of the price of gold, even got below 1%. We divide an ounce into ounce and you find it was 1% of the price of gold. If you go back through 50 years of history and look at that spread relationship, you'll see that when you get down to the 1% level, it's time to buy silver. Okay, it's meaning it's dirt cheap. It's not going to go to zero versus gold. Okay, but then the technicals turned, and so over the last 4 or 5 months, you've seen silver outperform gold. Like for example, back in April, gold hit 3,500. It's gone sideways. April, May, June, July, now August. 4.5 months of comatose but steady sideways. They keep trying to sell it, but then go down. But it also doesn't go up. So it's had a sideways correction, which is, by the way, not the way gold ever tops. Okay. During that time, silver's gone up sharply. Okay. We assess technically that silver's now at a point where it's going to outperform gold fairly dramatically. If you go back over 50 years and look at that same spread, you'll see the number of years it got up to at least 2% of the price of gold was like 21 of those 50 years. So it's not abnormal at all. So from the recent low of 1% to 2%, meaning silver could double in relative value to gold, probably over the next year. Wouldn't be surprising me by the end of the year even. Same is true with the gold and silver miners. They're back into outperform mode versus gold. And if you'll look at gold sideways since April, look what GDX has done, vertical. Okay. So I think those parts of the monetary complex are the place to be right now. Silver, the gold and silver miners. Gold will re-engage, and I think it's going to re-engage probably later this month or next to the upside, where people say, oh, it's awake again. Mm-hmm. But silver and the miners will be the place to be.
Silver appears to be entering a powerful new bull phase, supported by historic undervaluation relative to gold, record industrial demand, tightening supply, and strong technical momentum. With prices breaking out to multi-year highs and miners still undervalued, analysts like Michael Oliver see silver leading the precious metals complex, potentially reaching levels far beyond its old peaks. This makes silver and mining stocks some of the most compelling opportunities in today's markets. If silver truly enters a supercycle, how high could prices realistically go beyond the $60 to $70 near-term targets? With mining stocks still undervalued, should investors focus more on physical silver or silver equities to capture the upside? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up. Because by the time the ETF buyers have a shot, they could be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Gold hit a more than 4-month high on Monday, as increased bets for a U.S. Federal Reserve interest rate cut this month lifted bullion's allure, while silver rose above $40 per ounce for the first time in more than a decade. Peter Schiff expects a strong move higher, possibly as early as Tuesday, and advises buying silver now before prices jump, since ETF buyers might face much higher levels. The same goes for gold. If it gaps above $3,500, that would be a significant $50 move, supported by both strong fundamentals and technical momentum that could trigger a breakout. Peter Schiff, an American stockbroker, financial commentator, and author, highlights that gold appears to be entering its next big rally, likely beginning when it broke above prior highs on Friday, setting the stage for a quick move toward $3,500. As of early Asian trading on Sunday, it was around $3,448 after briefly topping $3,450. Silver also hit a 13-year high Friday, closing just shy of $40, and is now trading near $39.72. Both metals look technically and fundamentally strong, helped by a weaker dollar index, which closed below 98. The U.S. bank holiday is contributing to thinner liquidity, which is also exacerbating some of the moves in gold and silver. Silver is making a move higher in response to expectations of lower U.S. rates, while a tight supply market is helping to maintain an upward bias. Peter Schiff recalls predicting a golden age for gold during Trump's presidency, noting that while Bitcoin is being promoted as digital gold, it has underperformed, trading below its prior peak despite hype, ETFs, and official support. Gold, by contrast, is hitting record highs, far outpacing Bitcoin and stocks. They warn that Bitcoin looks like a pump-and-dump scheme and suggest converting it into gold or silver instead. Let's dive into Schiff's video for more insights. If you find the content engaging, please consider giving us a positive review and subscribing to our channel to receive the latest updates.
Gold, I think, is finally getting ready for the next leg up. In fact, it probably started that leg up on Friday by going through the highs. But now I think we've got clear sailing to get up to 3,500. I think we'll pass that relatively quickly. In fact, I'll take a look at where we're trading right now. Early Sunday evening, so Asian trading has just kind of kicked off. And in the gold market, let me pull that up. Yeah, no, gold's down about 90 cents, 3,448. A few minutes ago, it was trading above 34.50. Silver also on Friday, silver closed at a 13-year high. We came within 10 cents of $40. Right now, we're trading at 39.72, which is up about a dime from where we closed on Friday. But both gold and silver looking very strong, technically, fundamentally. The dollar was also weak on the week. Dollar index closed back below 98, about 97.80. So weakness in the dollar also working to help the gold market. But I think there are major, fundamental stories that are going to be fueling this gold market rally. I said it on this podcast when Donald Trump gave his first speech as president and announced the golden age in America. I said he's right in a literal sense. It was going to be a golden age for gold. And so far, gold is off to its best start probably of any presidency in history. Trump may not be making America great again, but he's making gold great again, not by intention, but the unintended consequence of his policies, right? He's trying to tout Bitcoin. Bitcoin is only up about 14% on the year, right? Gold is killing it. In fact, Bitcoin is 13% below its peak, right? Clearly, it's not digital gold. Gold's making a new record high. Bitcoin's in a correction. It could easily enter a new bear market pretty soon. And of course, the stock market is, gold stocks are crushing the returns in Bitcoin. But Bitcoin is still today about 13% lower than it was at its peak 4 years ago if you price it in gold. So despite all the hype, all the Bitcoin ETFs, the Bitcoin treasury companies, the strategic Bitcoin reserve, America being the Bitcoin capital of the world with the first Bitcoin president, Bitcoin is still lower than it was before any of that stuff happened. So how is that possible? How can all this good news and all this new buying not drive the price higher? because there's a lot of people smarter than the people who are buying who have been selling into all the hype. This is a gigantic pump and dump that's going on with Bitcoin. And the big pumpers now are the Trump administration, and all of their friends are the dumpers. But if you're smart, you'll get rid of what Bitcoin you have, and you'll go down to Shift Gold, where we work with BitPay, and you'll take your Bitcoin and you'll buy some gold or you'll buy some silver. This is a holiday weekend, so the U.S. markets are closed on Monday. I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they could be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Peter recalls how mainstream financial media often ignored gold, even when it was making major moves. He remembers being on CNBC years ago when gold had risen about $40. To him, that attitude showed a lack of understanding, because gold isn't just a commodity, it's money. Historically, even Alan Greenspan used gold as a key measure of monetary policy, warning that high prices signaled excessive looseness. Today, with gold around $3,450, it's clear that monetary policy has been far too loose for decades. Central banks themselves treat gold as the most important asset, stockpiling it while shunning other commodities. Rising gold prices, Peter Schiff argues, are a warning sign of deep economic problems in America, yet many still dismiss it while hyping Bitcoin instead. He stresses that central banks, the insiders of the fiat system, are effectively dumping dollars in favor of gold, signaling a loss of confidence in paper money. Investors should follow their lead by shifting into gold, silver, and international value stocks, which are already seeing strong returns as money flows out of U.S. assets. Now let's dive into the interview.
They barely talked about gold, as gold was making all-time record highs. I still remember when I went on CNBC back when they still had me on. I hadn't been on like 10 years. I don't know. I can't remember when I was on. But when I used to be on every week, but when I first started going on, I was on Squawk Box, and the host was this guy, Mark Haynes, who passed away quite some time ago now. But the first time I was on, of course, I discussed the price of gold, and I think it was still below 300, or maybe it was in the low 300s. I forget. But I came back, I don't know, a few weeks later, and I'm in the studio again talking to Mark Haynes. And I said, Mark, gold's up about $40 since the last time I was in this studio. And his response to me was, who cares? Who cares about the price of gold? And, he mentioned a number of things where he cares about the price. But he says, I forget, maybe it was bread or oil, I forget. But he said, why should I care about the price of gold? Right? He is the anchor in a financial news show. It's supposed to be focusing on finance, investing, economics. And he says, who cares about the price of gold? I mean, how could you not care about the price of gold? Only if you just don't understand what gold is. I mean, gold is money. It's you're a show about money. How could you not care about gold? And when the price of gold is going up, especially like this, it is a warning. It is telling you that there's a problem, right? I mean, even Alan Greenspan, I talked about this, he used to use gold as his primary reference to know whether or not he was too loose or too tight. He used to say that if gold gets up near 400, I'm too loose. If it goes below 300, I'm too tight. Now, what does that say? Look where we are now, 34.50. We've been too loose for decades based on Greenspan's metric. But no, gold is the most important price. It's not just a precious metal. It's not just a commodity. It's a monetary metal. Central banks are holding gold for a reason, right? How could you say, oh, I don't care about the price of gold? Well, what about all these central banks that are hoarding all this gold? Don't you think that's significant? Because, you know, they're not stockpiling other commodities. They're owning gold for a reason. It is the single most important price out there. And right now it is screaming that there is a huge problem. There is something rotten in the state of America. And that's what you're seeing in the gold market. And, you know, I'm sure that mentality still exists today. The same one that Mark Haynes had, even though he's not around anymore. I think that idea that who cares about the price of gold, right? What's the big deal? It's nothing, right? It's just a rock, right? You know, they care a lot more about Bitcoin than they do about gold. But if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system, right? So if you see in a company, if all the managers are dumping their shares, they might know something that you don't. Well, this is basically what's happening. The managers of the fiat monetary system are dumping their dollars. They want out. And they're buying gold. They're not buying other currencies. They don't want another fiat currency. They want real money. You should do the same thing. And the same thing is happening with investors. Not necessarily in gold, but they're dumping their U.S. shares and they're buying back their own stock. Right? That's why, you know, my dividend payers fund is almost up 40% on the year now. It's at 39%. It's on the high of the year because value international dividend paying stocks, that's where people are putting their money now. That's where when they sell in their U.S. stocks and they sell their dollars, they're bringing their money home and they're buying value. They're buying income, right? They're buying these dividend paying stocks. I think we're still early in this trend.
Gold and silver are showing clear signs of entering powerful new rallies, with central banks and investors driving demand while the dollar weakens. Peter Schiff emphasizes that gold's record highs are not just a market trend but a warning of deeper economic issues tied to excessive money printing and debt. He argues that unlike Bitcoin, which he views as speculative hype, gold and silver remain true stores of value and the assets central banks themselves trust. For investors, the message is clear: follow the smart money into precious metals before the next breakout accelerates. Do you think gold's rally toward $3,500 will trigger broader recognition of it as the ultimate safe haven? With silver nearing $40, could this be the start of a long-awaited move into triple-digit prices? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
The U.S. government has moved to impose tariffs on deliverable gold bars, reversing previous expectations that bullion imports would remain exempt under President Trump's reciprocal tariff structure. A July 31st CBP, that's the tariff organization, letter reclassified the bars as, quote, semi-manufactured, making them subject to duties under code 7108.13.5500. This decision sparked a surge in New York gold futures, where December contracts traded over $125 above London spot before easing back into what you see there. Switzerland, the largest exporter of kilobars to the U.S., faces heightened trade pressures following a 39% country-specific tariff.
The U.S. Customs and Border Protection ruled that 1 kilogram and 100-ounce gold bars from Switzerland fall under a tariff-bearing category, overturning prior expectations of exemption. This threatens Switzerland's position as a central refining hub and could disrupt global bullion markets, making them subject to tariffs ranging from 10% to 39%. This move disrupted the international gold market, with the London-New York price spread surging to over $100 per ounce, compared to the usual 30 cents. A major gold refinery in Switzerland halted deliveries to the US following the CBP ruling. The change could fragment the global gold market, prompting buyers to shift toward non-Swiss bars at premiums. It also puts pressure on CME Group to address delivery issues for futures contracts. If upheld, the tariffs may reshape gold trade flows and force costly supply chain adjustments. Renowned market analyst Vince Lanci is known for his perceptive analysis of trading in commodities and precious metals. He discloses that certain huge gold bars, 1 kilogram and 100 ounces, are currently subject to tariffs from the United States. These bars are frequently used in EFP transactions as well as wholesale bullion trade. UBS is cautioning that the increased costs of these US taxes on massive gold bars may lead to a mass closeout of short exchange for physical positions, which could cause disruptions in the funding markets. The unwinding of these trades, which are typically settled in London, may complicate funding circumstances because it would create an unexpected demand for cash and liquidity in the city's bullion market. The apparent decision by the US Customs and Border Protection Agency, announced privately in a letter to a Swiss refiner on July 31st and made public on Friday, sent gold futures in New York soaring to a record, as insiders warned that the tariffs would have dire consequences for the market. Then, just as quickly, prices tumbled after the Trump administration suggested imports of gold bars wouldn't face tariffs after all. In the 12 months to June, Swiss exports of gold to the US were worth approximately $61.5 billion. Switzerland's rate is among the highest in the world, after Brazil, Syria, Laos, and Myanmar. According to reports, gold bars were in such high demand in the US in May following Trump's announcement of sweeping reciprocal tariffs the previous month that Costco capped the number of gold bars that could be purchased in a day. Let's jump into the video for more details. If you like what you see, please give us a thumbs up and subscribe to our channel to stay updated on our latest content.
Refiners in Asia have also paused shipments as uncertainty spreads. Industry experts warned the move could destabilize the gold futures market's pricing function, with UBS and BNP Paribas strategists questioning whether the ruling was an error or a fundamental policy change. To put a little bit of color on the mechanics of what is going on and why this is affecting the market the way it has, before giving you a very simple big picture overview. London deals mainly in 400-ounce bars. US contracts are for 1 kilogram or 100-ounce bars. During COVID, the problem that's happening right now also arose. When there is demand for US delivery, London bars are sent to Switzerland to be re-refined or refabricated into US formats. London has been the default physical hub for gold for decades, while the US has focused on making a more robust futures market. Dealers in London are typically long metal in their vaults in London and hedge by being short US futures through the EFP carry trade. They are long London gold, 400-ounce bars, and short US gold, 100-ounce bars. If US delivery is called, which historically is rare because the COMEX is a paper market, and everybody knows that you should want to get your metal from London, they would take the metal that they have, their 400-ounce bar, send it to Switzerland where the refineries are, have the Swiss break down the 400-ounce bar into 4 100-ounce bars, changing the format, satisfying US rules. The new tariffs disrupt that trade. A London trader, long gold and short US gold, long London gold and short US gold, now faces a choice. First of all, London traders have been doing this for years. They're long the physical and they sell futures against it legitimately to carry the differential. It's kind of like lending money out. Gold is money. And they get comfortable doing that. And it gets to be a crowded trade. It gets to be a lopsided trade. And so they have these large legacy positions that they're always massaging. But when news like this comes out, and you can't take your 400-ounce bar and put it into 4 100-ounce bars to ship it to New York, if someone ever wants the physical, you have a problem. You can find another refiner, not possible overnight. I wouldn't give you any. Squeeze the shit out of you, excuse me. You could do nothing and die a painful death, or you can buy back the US contract quickly. So they're short the US and they're long London. So they buy the US contract quickly, and then they decide whether or not to sell the London contract. So it's a regulatory contract issue. If somebody in the US were to say, I want the gold, as we have been doing, well, then you would have to get the gold. The driving behind the price higher is this covering or this unwinding of the EFP, which is really just a spread between London and New York. This exposes the weak link in the triangle of trade. London acts as an intermediary, but problems in metals markets over the last 5 years, gold, silver, and nickel, for example, and copper, have been venue or fungibility problems. Again, very similar to what happened during COVID. Supply chains that are too long are being shortened. Now, to zoom out on a little bit of a big picture thing here, because this is all part and parcel of what's been going on over the last 3 years.
Vince points out that the conventional relationships between the US and London gold markets have been upset by this sudden action. There was a notable pricing disparity, as New York futures reached all-time highs, while London spot prices remained essentially unchanged. For example, London spot prices closed at $3,439.10 per ounce, while December gold futures hit $3,534.20 per ounce. The White House announced that it would issue an executive order to clarify its tariff position in response to market turbulence. The goal of this action is to clarify any confusion and establish stability in the bullion market. The current state of affairs underscores the intricate relationship between international commodity markets and trade policies. As the U.S. administration seeks to assert its stance on gold imports, the broader implications for the gold market and its participants remain to be seen. The White House's upcoming executive order should hopefully clear things up, said the logistics source. Protecting the U.S. gold futures during this uncertainty are high stocks of gold in COMEX-owned warehouses after massive inflows over December-March as traders hedged against the possibility of broad U.S. tariffs hitting bullion imports. The COMEX inventories currently amount to 86% of open interest, against a more normal 40 to 45%. So there is no liquidity issue at present, said StoneX analyst Rona.
With copper earlier, London spot prices were largely unaffected and are now lower. This reflects the weakest link in the triangular gold trade between London and the United States, as I just said. Moving on to the immediate potential effects. If the move is intentional, it is a game of chicken with the potential to disrupt the gold market at the financial side substantially. The negotiation is with Switzerland, but it highlights that Western gold's trade weak point is physical supply in London, while Western demand is increasingly in the US, pulling the gold over here. The supply chain must shorten. Because gold is also money, restricting its movement is weaponizing our payment chain. If unresolved quickly, this will push market participants into their own corners, taking their kickballs and going home, but more aggressively, make global trade more fragmented and bilateral, with every deal negotiated separately. If Trump meant to do this, he could still adjust course, as he recently did with copper, depending on the reaction. The Swiss have already offered, as we said, at least verbally, to consider moving refining capacity to the US. It is unclear how serious that is. If it was unintentional and the result of a classification error or Trump just bluffing to see how they'd react, the decision could be reversed within days. For now, given the opportunity, this is effectively a coin flip. Traders might use this as a point to close positions, winning or losing, until there is clarity. The implications are significant, but the core story is here. Related posts. By the way, that full story is in Tariff Shock Triggers Historic Gold Market Location. The link is there. Related post. Last night we put it out. U.S. imposes tariffs on Swiss gold bars. Yesterday we also put out UBS raises the 2025 demand roof. Suspicious, no? Founder special, Fed death, gold industry coming to America, as we thought would happen. Swiss offer U.S. its gold industry and trade talks, and the must-watch report from yesterday. Okay. We have a little note here we just want to say. Isn't it interesting, I won't say the word suspicious, that within days of each other, the Fed weighs in on gold revaluation? The LBMA is exposed as a weak link while we're trying to repatriate our own gold supply industry. These things point to potential revaluation of gold. They definitely point to a deepening and a realization of the importance of gold in global trade going forward. They show the LBMA problems, and we need to secure our payment and supply chains for gold if we view it as an international asset that's needed. Other metals would follow. In 5 minutes, he could reverse this and say, I didn't mean it. And you could think that he's either screwed up or bluffed. And you'd say he's a dummy. Or, and this is equally true, Trump has a habit of, most government does, but Trump has a habit of shooting and then aiming. So perhaps he shot and aimed because he wanted to see how they can react. You know, when you're the incumbent, you get to make those mistakes. That's why Microsoft software sucks, because they can put it out and then fix it later on. Anyway.
This steep tariff on Swiss gold bars marks a significant escalation in U.S. trade policy, potentially reshaping global gold flows and driving up domestic prices. With high demand already evident, as seen in Costco's purchase limits, the new levy could further tighten supply and increase costs for American buyers. How might these tariffs impact gold prices in the U.S. over the next year? Could this lead to increased smuggling or alternative sourcing of gold? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.